whether the markets are efficient or not, and what do we mean by efficiency itself. The most common meaning of efficiency that we discuss in this context is efficient processing of information. So whenever we are talking of word market efficient, it's not transaction efficiency, right? It's not allocation efficiency. It's more from an information efficiency standpoint. Means whatever the information that is available, is it reflected? How quickly is it reflected in the prices? Right? So let's say a new news breaks up. How quickly is it incorporated into the share prices? Because any news, any data that comes out, different people process it differently. Probably you may think that that is a good news. I may think that it is a bad news. But some processing has happened, and based on the processing, people react immediately to that particular information. And that particular reactions will, if the market is very efficient, that particular reactions are happening immediately and they are getting reflected into the stock price very quickly, or for any market. It's not only stock market. See, when I say this particular, let's say I say the bond market is not efficient, which means whatever the political situation changes or economic situation changes, immediate buying and selling of the bonds, if it does not happen frequently and it does not reflect the prices immediately after the news is broken out, we are saying that those markets are not efficient for us. But stock markets, the moment a company releases its financial result, the markets immediately react to that number in terms of either a lot of buyings happening, lot of sellings happening. That information processing and reflecting in the share prices of the company is what we are talking about, the efficiency of the market. So here when this chapter of market efficiency is being looked at, we are more talking about the information efficiency. So that's where the statement is saying security prices, they reflect all the available information fully, quickly and rationally. Right? People think how this particular news is going to impact the performance of the company, and based on that they rationally think that the share price will either go up or go down. Right? It's not a gamble. They think a little bit in terms of whether this particular news is going to be good or bad. It's not a 50-50 toss. Of course, though some kind of decisions will be equally good, equally bad, but people have their own processing mechanism. And what we are saying is every information that is available, if it reflects fully, quickly and rationally, we say that the market is efficient. Again, that is even more a mechanism to say that no one can make unlimited undue profit in this kind of a market. Probably I'll give a much better example to compare with. When will I say a particular examination system is efficient? Probably let's say if people read the last 3-4 years question papers and they are able to confidently get 80-90% in the current year, right? Then I can simply say that the examination system is no way efficient. Because just by knowing some past information or just by doing some basic research work on the question papers and something, if a person is able to generate a success consistently, then it means he knows how to beat the system. He knows how to generate profit consistently. When see in some markets, okay, there you are passing, but it's not at the expense of someone else failing. Everyone is passing. But if we look at it the other way, that only 30% of the people pass, your gain is always at the other person's loss. The financial markets work like that only. One person's gain is the other person's loss. So now if you are able to make constant gains, consistent gain by some mechanism or the other, it means someone is losing consistently. And when someone is losing consistently, why will ever he come to the market? No one wants to invest in a market where he will lose every day, right? So which means the market is like a system. Okay, some person who is very good at finance, probably he may, or who is very good at understanding the behavior of the market, probably in 70%, 75%, 80% of the cases he should be able to make abnormal profit. But at least 20% of the cases he may not make the profit, because system is much bigger than an individual. No one can make undue abnormal kind of profit consistently, because different not a single person cannot process all the information that is coming in, right? So the understanding the complexity of the system is not that easy, which means a person who knows some mechanisms of valuations and blah 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 stuff, he should be able to make profit, but not that consistently. He is only making profit better than others, but it's not that he will make the profits every time. If he is able to make a profit every time abnormally, then it means he knows how to beat the system. And if someone knows how to beat the system, then probably there is a possibility that the system will become more and more inefficient. Like if one person knows how to leak the question paper consistently, he can make the system fully inefficient. Probably it will not stop only with him. He will try to create the Xerox copies of those question papers. He will try to create a kind of a mafia gang internally, who will be responsible for selling the leaked question papers for a huge price, make money out of it. He can make undue profit, and that makes the system more and more inefficient. So we have to really know, see, any investment that any person is willing to make in a market, he will generally invest in that market which he finds is more and more efficient, right? I don't want to put my money in that particular market which can be manipulated very easily, where some person knows how to manipulate the numbers and create a profit for himself, right? In those kind of markets, I don't want to put my money at all, right? Probably sometimes we say, right, in case of lottery, I don't want to buy a lottery ticket, because sometimes or probably these shops and showrooms, they announce so many bumper draws. We have a very common feeling in our mind which will say anyhow they will give that bumper prize of a car to some of their relatives only. So when we know that that is the scenario, that lottery system process is becoming inefficient, though they may be doing it on a very impartial basis, but majority of the people have that kind of a thought process, that particular bumper prize is given to someone internally itself. So they may have to adapt to some other process to make sure to ensure the people that that process is very efficient. So they may bring a big celebrity to do the to identify who is the winner of it. So they do various other things to ensure to the people that what they are doing is more genuine, and it's not an inefficient kind of a process. Similarly, when we talk about the stock markets or any market, any information that is available, the person should be able to process the information, and he should be able to invest accordingly, and sometimes make a profit, sometimes may not be able to make a profit, because Someone else might have reacted already immediately to that, or majority of the people reacted in a different way, and I have reacted in a different way. So all these things could very well be different from person to person. So that is where what we are saying is only unexpected information should elicit a response from the traders. Otherwise, should have already got reflected into the price. When, see, if you are expecting the company will grow at 10% every year, if it has grown at 10% only, no big change should come to the price of the company. But if it has grown at 25% when they have released the result, or they have grown at -5%, because people, all of them have thought that it will grow at 10%, and based on that they might have processed that information, they might have purchased the shares accordingly. But if the reality is 25 or -5, which is much away from their expectations, then that unexpected information elicits some kind of quick reactions from the traders at that point in time. So what we are saying is, if a market is fully efficient, even active investment strategy will not give any positive return. Like, which means mutual funds is of no use. Portfolio management is of no use. If the markets are fully efficient, all these things will not work at all. So don't use your own fund management. You follow the index passive strategy. Because at some points in time, we see that the markets are inefficient, because not everyone will process the information in the same way, right? So sometimes, even if everyone has processed the information, you may process it in a completely different way and find a gap. And those are the ones where people are trying to make a profit, right? Probably everyone is thinking that the market will move like this, but you have thought that the market